Hey guys, welcome back to the channel. This video is going to be more casual in nature because I want to respond to this comment on my channel by Running a Rabbit. And it says, can you test DIVO against DIVB? I started to think about stock buybacks and how it could improve the general stock price. With dividends reinvested, I'm seeing DIVB outperforming DIVO starting in 2017. Would enjoy your thoughts and thanks. I want to do a quick shout out to all you guys that have been watching and leaving comments. The channel has been doing really phenomenal lately, and I'm going to work really hard to continue that, but just thanks for watching. It really means a lot to me. So with DIVB, this is what I'm going to do. I'm going to show you guys my general research process and how I go about judging if an ETF is good, how I compare it versus others, and all that kind of stuff. So the first thing is just to read the description to see what it's all about. So the investment seeks to track the investment results of the Morningstar US Dividend and Buyback Index. The underlying index is designed to provide exposure to US-based companies that return capital to shareholders through either dividend payments or share buybacks, which are the two major ways that companies can return profits to shareholders. So this ETF is focusing on both of those, dividends and share buybacks. So the next thing I do is pull up ETF.com to begin looking at the data because dividends and buybacks all in one ETF might sound great because after all, this is a financial product, so that's great marketing, but we have to see if it's any good. And ETF.com has this free tool which shows you the total return, which is the single most important thing. I cannot stress this enough. People ask me why I focus on this with dividend companies and ETFs. And that's because no matter what investment it is, the total return is ultimately the only thing that matters. And I'm going to talk more about that in a second. But this is the total return chart over the past year for DIVB. And you always have to benchmark it against the market, which is the S&P 500. So this puts it into context. And we can see DIVB has actually been doing better than the market by a little bit. If we zoom out, we can see that the fund isn't 5 years old, so let's zoom back into 3 years. So this gives us the longest possible time frame, and we can see that it's done just as well as the S&P 500. Now, the next thing I want to look at is the dividend data, because that's a pretty large focus on this ETF. So if we come over to Seeking Alpha, look at some of the data, we can see the dividend yield, it's low, it's 1.73%. It's not that old, so if we look at the dividend growth rate, we can see it's in the single digits, close to 9%, so pretty high, but nothing special. And once again, if we compare that versus the market, go to the dividends, we can see the S&P 500 is just under 1.3%. So the next logical question is, why would you pick this ETF over the market? In fact, if we come over to this tool, which shows the overlap in ETFs, I have SPY and DIVB, and we can see that these ETFs are 65% similar. So there's a ton of overlap, which explains why the performance is so similar. There's not a lot different between these ETFs. So now there's a concept I want to explain to you guys. So as mentioned before, when it comes to any investment, the total return is the number one thing because we're investing to make money. And the total return captures all the ways that a stock can return profits to you. Now this total return can be split up along a spectrum. On one side of the spectrum, we have growth, which is price appreciation. And on the other side is cash flow in the form of dividends. So it makes sense that no matter what we're looking at, we want to maximize total returns or at least have very competitive total returns to the general market, right? We don't want to fall behind it. And as investors, we can choose where we want the total returns to come from on the spectrum. Do we want to have more dividends and be on this side of the spectrum, or have more hyper growth and just all share price appreciation? And no matter which path you go, the total return is still the number one priority. Even with dividend stocks, if you're all the way over here, you still want to have good total returns. You just want most of that paid to you in the form of dividends and cash that you can go and live off of. And bringing this back to DIVB, the general market, the S&P 500, it doesn't have the highest dividend. It's kind of like over here if I just had to roughly kind of put it on the spectrum. And DIVB, it's so similar. I showed you guys the overlap. The dividend yield is almost the same. It's a little bit higher. And the total returns are the same as the market. So DIVB is like right here. It's not very different at all. And to me, what that means is DIVB is a very niche financial product that only appeals to a small group of investors. And those investors want a yield that's slightly higher than the S&P 500 with the same overall total returns. So you guys know I like Divo a lot, and let me explain why. So Divo does fall behind the S&P 500 by a little bit, but it's close. It's very competitive. You don't fall behind by that much. And a lot of that return is paid to you out in dividends. So it's captured in the cash flow side of the spectrum. So if I was to put it on the spectrum, first of all, it checks off the total returns. It's competitive. It's not the best, but it's pretty good. And then on the spectrum, it gives you those returns way more on the dividend side of the spectrum. Another ETF I really like on the other side of the spectrum is the ARK funds. So ARKK is the ARK ETF that I invest in. And that's because it focuses on innovation, which is whatever, it's a theme. Thematic investing can work. Another example of thematic investing is ICLN. This is a clean energy ETF. So of course, if you think clean energy is the future and it's going to revolutionize everything, you might want to invest in it because you believe it's going to have market-beating returns. So ARK is like that, but it's more broad. It's just innovation and technology, which I think is a very nice growing field. And I think over the next 5 years, the ARK ETFs have a pretty solid chance of outperforming the market, all of which comes in the form of price appreciation. So to put it on this graph, of course, the ARK ETFs check off the total return. It's a hyper growth ETF, and it gives all of that to me in share price appreciation. So to summarize, ARKK and Divo are two of my favorite ETFs. We can see how they land here on the spectrum. Divo is way more on the cash flow and dividend side of things, and ARK is all on share price appreciation. But what they have in common is the total returns. Divo is very competitive and close to the S&P 500, and ARK, I think, has a solid chance of outperforming the S&P 500. So no matter what, this is always my focus, and then in my portfolio I can adjust if I want more cash flow and dividends, or if I want to take a gamble and try to get the best returns possible. So hopefully that sheds light on my thought process behind all this. And DIVB is a great ETF. I mean, look at the past year performance. It's just that it's not differentiated enough, in my opinion, from the S&P 500. Like, there's not enough of a reason besides a slightly higher dividend yield to go with DIVB over SPY. But of course, this is just all my opinion and my take on this, so let me know what you guys think in the comments. I hope you enjoyed the video. I want to thank you guys for watching and supporting the channel. It really means a lot to me, so I hope you guys enjoyed, and I'll see you next time.